This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Digesting the data, conflicting economic reports leave investors scratching their heads. What will the Fed do next and when?
One direction, higher. That's where many believe mortgage rates are headed, leading some brokers to declare now's the time to act.
How safe is your pension? Does the ruling in Detroit and the overhaul in Illinois signal a change to retirement benefits nationwide? All that and more tonight on Nightly Business Report for Wednesday, December 4th.
Good evening, everyone. It's now 4 in a row. The Dow and the S&P fell again today, backing away from last week's record-setting highs. Blame it on a new batch of positive reports on jobs, housing, and the Fed's upbeat Beige Book survey on the economy. The takeaway for investors: the Fed will soon begin tapering back its stimulus plans, and that might not be good for the markets. Now, all this comes just 2 days before the release of the monthly jobs report, a key data point for central bank policymakers. So it's no wonder stock averages seesawed all day between gains and losses, and finally ending mostly in the red for the day. The Dow lost 25 points, but was down as much as 125 earlier in the day. The Nasdaq edged up only a fraction, and the S&P fell 2 points. And those same concerns about the Fed's next move sent the yield on the benchmark 10-year Treasury note above 2.8%. That's the highest since September.
So how does the Federal Reserve see the economy right now as it prepares for its next policy meeting later this month? Steve Leisman takes a look now at the bank's latest Beige Book survey of economic conditions around the country and what that, along with this Friday's November jobs report, could mean for the future of its stimulus program.
Some strong employment data today, raising prospects for better job growth, but also raising fears in the market of less Fed stimulus. The private payroll company ADP, in a much followed monthly report, forecast that payrolls in November rose by a strong 215,000 in the private sector, far above estimates of Wall Street economists. What's more, ADP revised upward the October report by 54,000 to 184,000 jobs. Now, ADP is only an indication of the more important government report on payrolls that comes out this Friday. But if 2 months of strong job growth are confirmed, it could raise hopes for a green Christmas for retailers. More people working usually means more spending on holiday gifts. The Federal Reserve reported in its Beige Book today, that's the collection of economic anecdotes from the 12 Federal Reserve districts around the country, that retailers were hopeful but cautious ahead of the holiday shopping season. Now, strong job growth would also indicate that employers looked through the 16-day government shutdown and hired anyway. That suggests underlying economic strength despite the fiscal fisticuffs in Washington. On the downside, the Fed is looking for sustained gains in employment as a condition for reducing the amount of stimulus in the economy. If Friday's jobs report shows strong payroll growth and lower unemployment, it will raise market fears that the Fed could cut back on its bond purchases designed to lower interest rates. The market will then have to judge whether stocks still look attractive with more Americans working, but less stimulus from the Federal Reserve. For Nightly Business Report, I'm Steve Leisman.
Well, another strength in the economy has been housing. But last week, applications for new mortgages fell nearly 13%. That's the fifth straight weekly decline, with mortgage rates ticking a little bit higher, now averaging 4.3% for a 30-year conventional loan.
But sales of newly built homes soared in October. That's the biggest monthly increase in over 3 decades. Too good to be true? Some think so. Also, that jump in interest rates has some lenders saying, act now before it's too late. Diana Olick reports.
At Pennsylvania-based Orleans Homes, business has been brisk ever since the government shutdown ended.
The government shutdown being resolved contributed to people's peace of mind, and I think they'd gotten hesitant prior to that, and when that passed, they came back from the sidelines right away.
And according to new government numbers out today, the story was the same nationwide. Contracts signed to buy newly built homes jumped an eye-popping 25% in October month-to-month after falling over 6% in September from August. So eye-popping, in fact, that some analysts don't buy it.
The real increase in new home sales, I think, looks much closer to about a 5% increase year over year, not a 25% increase month over month.
I don't believe those new housing sales numbers. Overall, the single-family construction market is still completely in a slump.
Why the distrust? Because sales have been weak for months. August's numbers were revised down by 15%, we learned today, and September's numbers fell from there, down 10% from a year ago. Then this huge October leap.
This number will likely be revised down as well, but even if you take it at its face value, you're still only going back to the April levels of new home sales, which is nothing stellar. It was a better market, but it certainly isn't a market that's soaring.
That's because mortgage rates are rising right along with home prices, and that will continue into 2014.
In the summer months, I think it contributed to demand. I think people thought we better get in now and lock up at the lower rates. And I think as that passed, it may have pulled some demand forward.
Mortgage rates then fell a bit and held steady for the past few months. But last week, they began to rise again and continued this week on positive economic data. A good jobs report on Friday could push them even higher. And that's why some lenders are urging their customers to lock in now. For Nightly Business Report, I'm Diana Olick in Washington.
To read more about new home sales and whether now's the time to lock in your mortgage, head to our website, nbr.com.
A new survey of CEOs from some of the nation's biggest companies shows they're more optimistic about the U.S. economy over the next 6 months and even expect to hire more workers. But the Business Roundtable, representing chief executives at 200 large firms, still expects the economy to grow at a rate of just 2.2% next year. That is unchanged from previous surveys.
Now, while those CEOs may have a rosier outlook on the economy, lawmakers in Washington appear to be doing their part. Reportedly, they are close to a deal on a federal budget. John Harwood joins us now from Washington. So, John, tell us how things are going and where do those budget negotiations stand right now?
Well, Susie, I'd say the lawmakers are doing their part a little bit. It does not look as if they're on the brink of a huge grand bargain deal, the kind that would put our long-term entitlement programs and revenue stream on sounder footing. But it is a modest deal that they're getting close to announcing, perhaps by the end of this week, that would reshuffle $90 billion over 2 years. It would lift the sequester caps with equal amounts being raised for both domestic and discretionary spending, and that would be offset so that it doesn't add to the deficit by some revenue increases, though not taxes, and some entitlement cuts, though not Medicare and Social Security, the two programs that have long-term funding problems. It's a modest deal, but lawmakers hope that they can announce it by the end of the week, enact it next week, and avoid a government shutdown in January.
All right, so, John, who are the winners and losers in this budget to the extent we know what stays and what goes? And maybe more pointedly, what does this mean for those looming deadlines, the government shutdown number, which was, I think, middle of January, and then the debt ceiling debate, which resurfaces then again, I think, right around the Super Bowl?
Tyler, it means both that the debt ceiling increase and the government funding are likely to occur as scheduled, avoid a crisis like we had. Lawmakers don't have much appetite for that, especially going into an election year. So in that sense, it's good news for the entire country. In terms of losers, the kinds of fees they're talking about, and again, we don't have a final deal, are things like higher airline ticket fees. The president had those in his budget. And when you look at the budget cuts, again, not Medicare, Social Security cuts, but federal retirement benefits would be cut somewhat. So federal workers could be losers to a small degree in this deal.
John, I also want to ask you about President Obama's speech today about the nation's growing income divide. But first, let's listen to this clip.
The idea that a child may never be able to escape that poverty because she lacks a decent education or health care, or a community that views her future as their own, that should offend all of us. And it should compel us to action. We are a better country than this.
So, John, what does the budget have to do with the speech the president gave today?
Well, the president has two goals. One, the first is do no harm to the economy. And if they can get a budget deal, avoid a shutdown, that would meet that goal. But longer term, he's got more proactive things he wants to do, like raise the minimum wage, spend on education and infrastructure. He may not even get those out of this Congress, but what he's hoping to do with speeches like this one today is plow the ground for future years, maybe even future presidents, to make progress on those priorities.
I'm sure it's going to create a lot of heated debate on the Hill. But thanks a lot for that update. John Harwood from Washington.
And still ahead, how safe is your pension, whether you work for a city, a state, or a private company? The price of oil moved higher for the fourth session in a row, just as U.S. inventories of crude fell for the first time in 11 weeks. Crude prices today up more than $1, closing at a 5-week high of $97.20 a barrel.
Meanwhile, OPEC oil ministers meeting in Vienna today decided to keep production quotas unchanged. The decision comes despite a new burst of oil production in the U.S. and the possible return of Iran's oil to the market. Steve Sedgwick has more.
Here in Vienna, OPEC ministers decided to keep output levels unchanged at 30 million barrels a day. A lot of questions remain, though, for 2014, with the announcement that Iran is back at the top table. Iran, of course, is having a rapprochement with the West over nuclear issues, and this means that potentially in 2014 we could see a lot more Iranian oil come to the market. The Iranian oil minister said to me, technically, they hope to put 4 million barrels of oil on the market later in 2014 once sanctions were eased. But of course, Iraq is producing towards 3.75, 4 million barrels a day, and there are hopes that Nigeria and indeed Libya can produce a lot more oil. This could lead to oversupply at some stage in 2014, but the next meeting scheduled for OPEC is June the 11th. It promises to be a very interesting meeting, what with the fact that we're also seeing an increase in non-OPEC supply from the likes of US shale, which the group today said was not a threat to OPEC, in fact was a welcome addition to global oil supplies. This is Steve Sedgwick for Nightly Business Report in Vienna.
Well, Carl Icahn wants candy from Apple, and that is where we begin tonight's market focus. Specifically, he wants the company to spend some of its cash to buy back $50 billion in company stock. Now, the activist investor revealed he filed a new shareholder proposal with Apple in late November. The fresh detail, his $50 billion current pitch is $100 billion less than he suggested back in October. That may be because the stock has gone up from when he suggested a repurchase at $525 a share. Shares were off slightly today, but they still traded above $525 at $565. And Disney is raising its dividend. The company's board of directors declared an annual cash payout of 86 cents a share, up 15%, and payable to shareholders, a record, at the close of business on December 16th. The announcement was made after the close. Shares finished the regular session slightly higher, $69.97. The apparel retailer Express is forecasting a weaker than expected holiday season, due in part to aggressive discounting. The company also reported a third-quarter earnings miss, and the CEO said on a conference call that he does not expect the promotions to end anytime soon. Shares down a big 23% to $19 even. Heyman Capital has reportedly taken a stake in General Motors. The hedge fund believes shares of the automaker could rise by more than 40% over the next 12 to 18 months. GM is said to be one of Heyman's largest investments right now. General Motors popped nearly 2%, $38.71 the close.
Higher prices and remodeling costs weighed on Bob Evans' second-quarter earnings. The food and restaurant company reported that profits plunged 46%. It also gave a weak outlook for the upcoming fiscal year. To counter slowing sales, the chain has tried to bump up menu prices and remodel eateries, tacking on extra costs. The stock dropped 5% to $52.33. Standard & Poor's upped its credit rating on Las Vegas Sands. The rating service did not quite lift the stock to investment grade, but it predicts a stable outlook for the world's largest casino. That sent shares up almost 4% to $74.51. Now, the famous short seller Jim Chanos has reportedly taken a large short position in CGI Group. A subsidiary of CGI Group is the company behind the plagued rollout of healthcare.gov. Reports of the short against the tech firm sent its shares down more than 3% to $34.99. And the nation's largest dealership chain, AutoNation, reported a 13% gain in new vehicle sales for November. Demand for domestic import and luxury cars all rose by double digits. AutoNation's CEO says Black Friday powered the sales gains.
If you look at the selling rate for the industry of annualized $16,400,000 for November and compare that to a selling rate of $15,200,000 for September and October, you see we really needed a big Black Friday, and we got it.
And the stock jumped nearly 3% to $50.21. Tyler?
Well, a new report from Experian, the credit report company, shows how Americans are paying for all those new cars and pickup trucks we've been buying. With the loan rates so low, more new car buyers are taking out bigger loans with longer payback periods. Right now, the average loan amount is nearly $28,000, and the average length of one of those loans has been stretched to 5 years and 5 months.
Well, student loan debt is higher, too. A new report shows that 7 out of 10 college graduates had to borrow money to wear their cap and gown in 2012. And they came out of school with an average debt of more than $29,000, the most ever.
Well, for graduates, too much debt can be a grave financial hindrance for households, businesses, and increasingly for municipalities. It can be a real crusher, as yesterday's landmark Detroit bankruptcy court decision makes clear. Today, taxpayers, pensioners, bondholders, municipal finance experts all across the country have been trying to figure out just what the Detroit decision might mean to them. Here to help us tonight is J.P. Aubrey, Assistant Director of State and Local Research at the Center for Retirement Research at Boston College. J.P., welcome. Now, if this decision is upheld, by how much might a typical Detroit pensioner receiving, say, $20,000 a year see their benefit cut? And how much do municipal workers in municipalities outside of Detroit need to worry about changes to their pensions?
Well, it's unclear how much cuts they will get to their pension benefits. It hasn't been decided yet. But what is clear is that cases such as Detroit have very little implications for the nation on the whole. Detroit is a special case. Pensions were part of the issue, but it has been a shrinking city with an industry that's been declining, as well as a revenue base that's been declining for some time. And so it's hard to see how cities around the nation could draw much from the situation in Detroit, being that it's so unique.
But you know, this whole question of pensions has been brought to the fore because of Detroit. But let's say I'm someone working in a city that doesn't have any problems. The question those people are wondering, how safe is my pension? Can we answer that definitively?
Not definitively, but in most cases, pensions are very well protected. I mean, you can look at the example of Detroit. They had to go through bankruptcy proceedings in order to touch these things. And so the burden of proof is on the city to make a case that they are eligible for bankruptcy, and that's a high threshold. And so for the most part, pension benefits are safe across the nation. In most states and localities, pension benefits are protected for current employees and their future accruals, and for retirees.
You know, but I'm looking at research that your own group put out saying that 126 public plans were only 73% funded using the most optimistic pension return formula, 50% using a more conservative 5% return figure. So what percentage of public pensions are underfunded? And there are the numbers that indicate that they are underfunded not by just a little, but in some cases by a lot.
Right. This is correct. Those numbers are exactly right. Currently, in 2012, based on our sample of 126 state and local pension plans that we maintain at the center, the funding ratio was about 73%. A lot of that unfunded liability isn't due to current workers. Pension funding really wasn't in vogue until about the 70s or 80s. So a lot of these unfunded liabilities are legacy costs from a past time, and plans have been working steadily to fill that gap. For example, in Massachusetts,
are the costs real or not? Are those numbers really speak to anything, or are you telling me that they don't really matter?
No, those numbers are real, but what you need to understand is that plans have been working steadily to fill that gap. So that was a unfunded liability from a past time, and they've been working steadily to increase their funding over the period in order to fill that gap. And so we're just not to the point where this funding of that gap has been completed yet.
JP, let me just ask you this. I mean, this raises the whole question that a lot of people used to take a job as a teacher in a public school or join the police force because they know even though their salary might be low, they were going to get good benefits and good pensions. It seems like that whole formula is changing. So what does this mean for cities, municipalities in terms of attracting top talent? Is this going to become a problem?
You raise a great point. At the center about a year ago, we did a study comparing public and private compensation, total compensation, that is their salaries plus their pensions and other fringe benefits like retiree health care. And we found that public and private sector employees basically get the same total compensation once you control for their age, their education, their time in the workforce. And so if you just cut an employee's pension benefits without giving them an increase in their salary in any way, you're basically offering them less in total compensation. Now, if I'm a young employee choosing where to go in the workforce, public or private, and I have a certain set of skills and I can get more money in the private sector for those skills, where do you think I'm going to go?
Yeah, JP, thank you very much. We appreciate your help tonight. It's a complicated, thorny question. JP Aubrey's Assistant Director of State and Local Research at the Center for Retirement Research at Boston College.
And coming up on the program, with cold temperatures deliver hot sales for some retailers this year. The calendar says December, but an Arctic cold front is sending temperatures far below normal across much of the nation this week. In California's Central Valley, citrus growers are bracing for below freezing temperatures, which threaten to damage hundreds of millions of dollars worth of orange, lemon, and other crops. Farmers are preparing to water down those crops and turn on wind machines to circulate warmer air to try to ward off damage.
Well, that same snap of cold weather has already made some retailers and apparel makers thankful that they won't be left out in the cold this holiday shopping season, as wicked wintry weather is coming just at the right time. Courtney Reagan explains.
A little chill in the air is at the top of many retailers' wish lists during November and December. And on the first key shopping weekend, Santa delivered early. Arctic cold air sat on most of the eastern half of the U.S. during the Black Friday week, pushing temperatures 3 to 15 degrees cooler than average for the week, making this year's Black Friday the coldest in more than 20 years for a large portion of the country. The results appear to have followed through just as retailers would hope. VF Corp-owned North Face and Decker's UGG boots were the only apparel searches popping up in Google's top 10 search trends over the Black Friday weekend. Foot Locker also says strength in VF Corp's Timberland business is making the shoe retailer optimistic about boots this season. JP Morgan analyst Matt Boss says the weather has been a positive X factor for retail, noting anecdotal evidence suggests it is impacting consumer buying. Boss says Macy's CFO recently told investors the department store sees increased opportunity to sell outerwear into the holiday season. In fact, a Weather Channel survey shows consumer demand for heavy outerwear increased 125% over Black Friday weekend compared to last year. Stronger demand means retailers can more easily sell goods at full price, especially important in one of the most promotional holiday seasons in some time.
The Goldilocks condition for a Macy's or a Kohl's is cold or colder than normal weather, not too cold. Some snow, some ambiance that feels like holiday to get people really sort of in that mood for Christmas. Weekends, they don't want anything falling out of the sky.
The Weather Channel forecasts the colder than normal temps will continue for at least the next 2 weeks. While current winter storm Cleon will likely hurt regional foot traffic temporarily, it is Christmas time. Gifts have to be bought somehow, which means retailers with strong online offers could benefit. For Nightly Business Report, I'm Courtney Reagan.
And finally tonight, Newsweek is making a comeback. The struggling magazine ended its print edition last year, producing only an online version. But now it plans to turn the presses back on. Starting as early as January, Newsweek is planning to print a 64-page weekly edition. And officials at the company say they'll rely more heavily on paid subscriptions for revenue instead of advertising. I just don't know how that's going to all work out.
Well, it's nice to see them make a try and come back.
That's Nightly Business Report for tonight. I'm Susie Garrett, and we want to remind you this is the time of year your public television station seeks your support to make programs like Nightly Business Report possible.
We'll see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a nightly business report news brief. The Dow and S&P fell for the fourth session in a row on concerns that a new batch of positive reports on jobs and new home sales, along with the Federal Reserve's upbeat Beige Book survey of the economy, means the Fed could begin tapering its stimulus plans soon. That sent stocks seesawing between gains and losses. The Dow was down as much as 125 points, but ended 25 points lower. The Nasdaq edged up a fraction. The S&P fell 2 points. The average new car loan is now about $28,000, and the average length has been stretched to 5 years and 5 months. And Newsweek magazine, which only publishes online, says it'll resume its printed edition early next year. Be sure to tune into Nightly Business Report right here on your public television station.